Bitcoin, a name that started with a whisper in cryptographic forums, now broadcast on CNBC, traded by hedge funds, and regulated by governments. But what is Bitcoin really? Why was it created? And how did a tool meant for peer-to-peer financial freedom become a speculative asset class parked in ETFs? In this episode, we're walking you through the full story. Bitcoin's roots, its tech, and its early use cases. What it has become and where it might be headed. No hype, no nonsense. Let's get started. In October 2008, right in the middle of a global financial meltdown, someone or a group calling themselves Satoshi Nakamoto posted a 9-page PDF file online. It was called Bitcoin, a peer-to-peer electronic cash system. No news coverage, no fundraising campaign, just a quiet post in an old-school email group for cryptography. The PDF laid out a system where people could send money to each other without needing a bank, no middlemen, and no asking permission. One line in the paper hit especially hard. The root problem with conventional currency is all the trust that's required to make it work. In other words, you have to trust banks to hold your money. You have to trust credit card companies to process your payments. You have to trust governments not to print so much money that yours becomes worthless. Bitcoin's idea was, what if we didn't have to trust anyone at all? What if money could just work by itself using nothing but math and computers? The system used 3 basic ingredients: digital signatures to prove who owns what, a peer-to-peer network so everyone sees the same version of the truth, and something called proof of work to keep people honest. None of those ideas were new, but putting them together like this, that was new. Bitcoin didn't launch with hype. It wasn't going to go viral. It was just a quiet revolution written in code. Bitcoin doesn't track your balance like a bank app. It works more like cash, real physical cash. When you get paid in Bitcoin, you don't just add money to your wallet. You get little chunks of Bitcoin called UTXOs. That stands for unspent transaction outputs. But forget that name for now. We'll just call them digital bills. Say someone sends you 0.3 Bitcoin, and someone else sends you 0.7 Bitcoin. You're now holding 2 separate UTXOs, just like having a $30 bill and a $70 bill in your pocket. If you want to pay someone 0.9 Bitcoin, your wallet might grab the 0.7 and the 0.3 and send them both. It creates a new UTXO for the person you're paying. And if there's anything left over, it sends the rest back to you as change, which is also a new UTXO. So instead of having an account balance going up and down, Bitcoin is always moving little chunks around. And once you spend those UTXOs, they're gone forever. The beauty here is that every node in the network checks the math itself, so there's no middleman. No one needs to approve your transaction. If the numbers add up and the signatures are valid, it gets added to the blockchain. But this setup has a catch. It's all public. Every UTXO, every transaction, it's all out there for anyone to trace. We'll get into the privacy problems in a bit, but for now just understand this. Bitcoin is like handing someone exact change in a glass envelope. They can't stop you, but they can sure as hell watch. Here's the part that trips people out. Bitcoin isn't private. Not really. People hear the words crypto or see some random looking address and they think it's anonymous. But every transaction is public, forever. Let's say you bought some Bitcoin on an exchange, like Kraken, Coinbase, or Robinhood. These are regulated companies. They took your ID, your address, and maybe even a selfie. Now you send that Bitcoin to something like a hardware wallet. Cool. Now it's in your control. But now there's a transaction on the blockchain that says this specific amount of Bitcoin moved from Kraken to this exact wallet address. The exchange knows the address belongs to you. They've got it recorded, and that record doesn't disappear, even if you mix the tokens with others later. And it gets worse. Every time you spend Bitcoin from that wallet, you might be spending multiple UTXOs at once. That links them together. Now someone watching can say, all these coins must belong to the same person. That's why chain analysis companies exist. They use those patterns to track your activity, even if you never gave them your name. Some wallets try to protect you. They use smarter coin selection. They avoid merging coins that shouldn't be connected. But at the end of the day, Bitcoin's design is transparent. Now, if you're looking for real privacy, you might want to look at coins like Monero. Monero doesn't just hide who sent what. It hides how much was sent and where it went. It uses something called ring signatures, so your transactions are mixed with decoys. It uses stealth addresses, so no two payments look alike, and it hides the amount entirely. With something like Monero, no one watching the blockchain can say who paid who or how much. Bitcoin doesn't have that. It wasn't built for that. So, unless you're mixing properly and watching your coin hygiene consistently, someone can always follow the trail. In the early days, Bitcoin was a curiosity. Some weird internet money mined on laptops, mostly traded between nerds for fun, or given away. Forums like Bitcoin Talk were full of people just experimenting. The famous 10,000 Bitcoin for 2 pizza story, that was real. At the time, 10,000 coins wasn't worth much more than a cheap lunch. But then came the Silk Road, a darknet marketplace where people bought and sold drugs, fake IDs, and all sorts of contraband. And the only currency accepted? Bitcoin. Why Bitcoin? Because you didn't need a bank. You couldn't get a drug deal cleared through Visa. But with Bitcoin, no one could stop the payment. It wasn't private, but it was unstoppable. That was enough for the time. And for a while, it worked. Silk Road ran for years, processing millions of dollars worth of Bitcoin transactions. Eventually, law enforcement shut it down. They didn't need to break the encryption. They followed the coins. The FBI traced addresses on the blockchain straight to the site's operator. Still, Silk Road proved something important. Bitcoin wasn't just a theory. It could be used right now to move money outside of government and corporate control. It scared those people, and it got Bitcoin attention, good and bad. After the Silk Road and the early forums, something shifted. People started realizing that Bitcoin wasn't just about usability, it was scarce. There will only be 21 million Bitcoin. That's hard-coded in. Every 210,000 blocks, roughly every 4 years, the mining reward of a new Bitcoin gets cut in half. So the first few years, miners got 50 Bitcoin per block. Then it dropped to 25, then to 12.5, then to 6.25, and so on. And no, it doesn't just keep cutting in half forever into nothingness. When you stack all that up, it covers towards 21 million total coins. It's like slicing a pie in half over and over. You never hit zero, but you get really, really close. The tail end gets tiny. So instead of spending Bitcoin like cash, people started hoarding it. And the halving cycle, cutting the new supply in half every 4 years, did more than just limit inflation. It created a rhythm, a kind of heartbeat for Bitcoin's price. Less new Bitcoin hitting the market meant less sell pressure. Combine that with growing interest, media hype, and the fear of missing out, and you get a feedback loop. First, the price hit $30. Then it crashed to $2. Then it hit $1,000 in 2013 and crashed again. By 2017, it was $20,000. Then it fell to $3. Every time Bitcoin came back stronger and the people piled in. This is where the term digital gold really started to take over. By 2017, Bitcoin was getting crowded. The network was only processing 3 to 7 transactions per second. That's nothing compared to Visa or MasterCard. And the fees started spiking. A simple transaction could cost $20, sometimes $50. People were waiting hours just to send a Bitcoin. Why? Because Bitcoin blocks are small, just 1 megabyte by default, and each block only gets added every 10 minutes. That's where the community split. One side said, just make the blocks bigger. More space equals more transactions, which equals lower fees. Easy fix, right? But the other side said, no, that breaks the decentralization. Bigger blocks means they're bigger files. That makes it harder for regular, everyday people to run full nodes. And if fewer people can audit the system, it becomes easier to corrupt. That's where SegWit came in, short for segregated witness. It was a technical change that made transactions take up less space inside of a block, without actually increasing the block size. That allowed more transactions to fit in the same place. It also fixed a few bugs that opened the door to a bigger idea, the Lightning Network. Lightning is the second layer built on top of Bitcoin. Instead of putting every little payment on the blockchain, you open a channel with someone, lock up the funds, and then you send them as an instant payment off-chain. Only the opening and closing of the channel gets recorded on the blockchain. Everything in between is fast and cheap. In theory, this lets Bitcoin scale to thousands or even millions of transactions per second. In practice, it's early. Lightning is powerful, but it's not very user-friendly. You have to manage liquidity, open channels, and most people don't even know it exists. So while the tech is improving, most users and businesses still stick to the base layer. And that means Bitcoin's not quite ready to handle mass payments the way Visa or MasterCard does. But it did survive the Civil War, and it became stronger for it, at least for now. As Bitcoin got bigger, the people holding it started to change. In the early days, it was hackers, cypherpunks, and privacy nerds. Then came the speculators, then traders and YouTube pumpers. But now, it's Wall Street. In 2020, a software company called MicroStrategy went all in. They started buying Bitcoin for their company treasury, hundreds of millions of dollars worth. Then Tesla followed, then Square, then the suits, BlackRock, Fidelity, Goldman Sachs. And with them came ETFs, exchange-traded funds that let people buy Bitcoin exposure on the stock market without ever actually touching the asset. Here's the catch. When you buy a Bitcoin ETF, you don't actually own the keys. You don't run a node. You don't even see the blockchain. You're trusting a custodian, usually a bank, to hold the Bitcoin on your behalf. Which is ironic. Bitcoin was designed to cut out the banks, and now the banks are packaging it up and selling it back to you as a financial product. That doesn't mean Bitcoin's failed. The core protocol still works. Anyone can still take self-custody. But make no mistake, the institutions have arrived. And they're not here for a revolution. They're here to make money. So where does that leave us? Bitcoin is over 15 years old. It survived price crashes, government crackdowns, internal wars, and endless media cycles. Today, the network is more secure than ever. Mining power, which is also called hash rate, is at all-time highs. But there's a catch. Most of the mining power is controlled by a handful of giant pools. Technically, anyone can mine Bitcoin, but practically is dominated by companies running massive farms with specialized hardware. Then there's custody. Most Bitcoin isn't being held by individuals in hardware wallets. It's sitting in exchanges like Coinbase, Binance, Kraken, or in ETF vaults managed by BlackRock and Fidelity. That means the average user never interacts with a protocol. They never run a node. They don't verify their own transactions. And that's a problem. Because the more people that outsource custody and verification, the easier it becomes for Bitcoin to drift back towards the very system it was meant to replace. Censorship and surveillance, it's all back on the table when you stop using the tools that make Bitcoin sovereign. That being said, the option is still there. You can still run your own node. You can still take full custody of your coins. You can still send Bitcoin without permission, without a middleman. Bitcoin hasn't been stopped, but it's been reshaped. Whether it stays true to its roots or becomes another investment product depends entirely on how people choose to use it. Some want it to stay conservative, just a hard money alternative to fiat. Others want to push it forward with smart contracts, better privacy, or a decentralized identity system built on top. Some are doubling down on layer 2s, like the Lightning Network. Others are building sidechains, like Liquid, or trying to bring programmability with things like RGB or runes. Meanwhile, governments are pushing for CBDCs, central bank digital currencies, that give them total control over your money. In that world, Bitcoin's value becomes clear. It's one of the last assets that lives outside of the system, but it only works if people treat it that way. If we give up self-custody, if we stop running nodes, if we let ETFs and custodians dominate, then Bitcoin becomes just another Wall Street product with a different ticker symbol. Technology doesn't choose sides. It reflects how we use it. Bitcoin was built to be free, neutral, and uncensorable. Whether it stays that way, well, that's up to us. If you got something out of this, drop a comment and subscribe. It's about staying informed and in control. Thanks for listening.